You've seen an overall allocation change, I think, from risk-on asset classes to bonds overall, certainly after the correction, equity market correction at the end of last year. So we've seen tremendous inflows into muni bonds, and a lot of that has been due to tax changes as well. So keep in mind, closer to tax time, that state and local tax deduction cap is on the mind of a lot of investors. So if you're a high tax bracket individual in a high tax state, munis are typically going to be the only asset class that's going to provide you that shield.
One more question on this before we go back to the big picture, but are people concerned about the long-term fiscal health of some of these states now that the cap is off? You know, New York, California, those high tax states where they say, well, wait a minute, maybe the population, as they get those tax bills, is none too happy.
Yes, I think you're seeing, and Governor Cuomo kind of alluded to the fact that the decline in tax revenues was due to an outmigration. While some of these high tax states might be seeing a little bit of that, I think it's important to focus on the fundamentals, right? So especially when it comes to these states and cities, unfunded pension liabilities are going to be the bigger issue to look at.
Yeah.
So for those states that are facing vast unfunded pension liabilities and where they haven't made much movement in correcting that, that's going to be very important to watch.
Which states are those?
State of Illinois is going to be kind of with the highest, right, unfunded pension liabilities. Next up would be New Jersey. What makes New Jersey...
I was afraid you were going to say that.
Yes, and they're already high tax state, and it makes it very difficult. So Illinois has raised income taxes closer to 5%, but when New Jersey's tax is close to 9%, how much more can we raise New Jersey state taxes?
Rachel, we'll talk about the Fed before we get into this any further. What do you make of all the comments between the minutes yesterday, the balance sheet, and they're perhaps holding it steady from now on? What does that mean for you?
So it definitely has been a confluence of information coming out of the Fed in the last week or so. Really what it's shown us is that the Fed is now wearing more of a risk management cap and looking at both being patient as far as rate hikes are concerned, but also having the flexibility with the balance sheet, which I think is, again, marrying both of those ideas together and creating some calmness in the markets regarding Fed policy.
So if the Fed is a risk manager, Rachel, should investors be more inclined to go out on the risk curve? I mean, right now it seems like everybody wants to favor value over growth. We have had underperformance of the FANG stocks, for instance. Should we reevaluate where we are?
Well, I think looking at the markets in general, we've obviously had quite a large climb back out of the hole that we had at the end of December, up some 18%. And at that point, what we saw was, and have seen, is across the board, risk assets and assets across all asset classes, style as well, really climbing. So I think there has been a bit of a risk-on mentality in the market. I think on the fixed income side, we're also going to be looking at what the Fed has to say as what the ultimate portfolio will look like and what that will mean for pricing within Fed assets and where we should be on the yield curve.